Now, if you guys are newer to investing, you're just getting started building out your long-term portfolio, this video is going to be perfect because we're going to be going over some very useful, important, yet beginner-friendly tips and tricks on how any investor, relatively speaking, with just $20 per week, yes, just a $20 bill per week into your stock market portfolio could compound into a massive portfolio long-term. And I'm not only going to share with you why this is possible, but also a real-life example, a real-life ETF that has done this for investors in the past and can potentially do so in the future. I'm also going to share with you the exact math behind this and how it works to give you a better idea on what the future could potentially look like for your long-term portfolio. So if you want to see exactly how $20 per week invested into the stock market long-term could potentially change everything for you financially, make sure to stick around, drop a like down below, and let's get right into it. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey. And my custom dividend tracker that I'm constantly using here on the channel has also helped so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. Now before we go through the real life example ETF, an ETF that has done this for plenty of investors since inception and could potentially do so in the future, along with all the math behind the $20 per week investment. Let's go over one of the most important takeaways when it comes to investing long term, and this is exactly why it's very important to get invested into the market as fast as possible. We're talking about the power of compound interest. It says compound interest is interest that is added to the initial principal of an investment or loan, thereby increasing the balance and, in turn, increasing the amount of interest earned or paid in the next period. The power of compounding helps the sum of money grow faster than if just simple interest were calculated on the principal alone. The greater the number of compounding periods, the greater the compound interest growth will be. For savings and investments, compound interest is your friend as it multiplies your money at an accelerated rate. Now, this is going to be a very important metric to pay attention to throughout your investing journey, and especially in the early days. You have to understand that, even like the example for this video, a $20 investment per week into the market over a long enough time frame, it will start to look like this. It's going to be slow at first. It's not going to happen overnight. This is not a get rich fast journey, but over time, if you just keep investing and reinvesting those dividends, and then let the power of compound interest do its thing, long enough in the future, you are going to see the chart spike up like crazy. Now, the reason I started this video really hammering in the power of compound interest metric to pay attention to for this video is just because a $20 investment, which is just $1,040 per year, invest into the market, you are obviously going to need the power of compound interest on your side, as $20 per week is not necessarily enough money to grow the portfolio very quickly, but it is enough money to grow the portfolio over time. Now, a great real-life example of an ETF that has allowed investors to compound their portfolio since inception is the VIG ETF, or the Vanguard S&P 500 ETF. Now, you've probably heard a lot of older investors, veteran investors, tell younger investors to invest in low-cost index funds, set it and forget it, keep adding more and more money to these index funds because they're cheap to hold on to, and most of the good ones grow like crazy over time. Now, I have to admit, in my early days of investing, I heard a lot of investors tell me this exact same thing, but for whatever reason, I ignored it and built a portfolio on my own terms, which didn't really do all that bad over the last decade. But if I would have taken that early advice and bought into low-cost index funds like VIG, for example, I would be up a lot more than I am currently. Now, VIG is an exchange-traded fund, an ETF, that costs just 0.03% to hold on to. Now, when expense ratios are this low, this cheap, you're not even going to notice it. The way that VIG works is it invests in stocks in the S&P 500 index representing 500 of the largest US companies. The goal for VIG is to closely track the index's return, which is considered the gauge of the overall US stock returns. So basically, if the overall stock market does well, normally VIG is going to be right up there in the front, sort of leading the pack. Now, remember I said earlier that I'm going to share with you a real life example that has not only compounded tons of investors' portfolios like crazy over a relatively short time frame, but can also probably do so in the future. The reason I wanted to use VIG for this example is because VIG, since inception, is up around 650%. And keep in mind, VIG hasn't been trading for 50, 100, 200 years. This ETF has only been trading since 2010. It's currently 2025, so 15 years has gone by, and this ETF is almost 7x'd. Now, another reason a beginner investor could potentially use something like VIG, I mean, there's tons of different ETFs across the market. I covered tons of them on my channel, so check out some other videos as well. But VIG offers exposure to around 500 different names, So you don't need to worry about a single stock performing good or bad, or even a single sector to really have a bad quarter or year. You are very well diversified with VIG. It's a sleep good at night ETF to hold on to, and it also pays a small dividend. Now, before we go through the final math, we have to get an idea on what VIG is offering as far as dividends as of right now. It's offering a 1.2 to 1.3% trailing 12-month dividend yield. The dividend growth over time is not bad also. Around 7% on average year after year is how much VIG has paid you more in dividends since inception. So for investors that bought into something like VIG, at least historically, have not only seen their investment go up in price over and over and over again, but also every single quarter on average, they've been getting paid more and more cash flow to then reinvest into more shares of VIG or do whatever they want with that money. Now, to go through the actual numbers, actual math behind a $20 contribution per week, which is $1,040 per year. Now, I know everyone has different amounts of money they're able to contribute to the stock market, but relatively speaking, there's not really any excuse that anyone shouldn't be putting at least a few bucks into the market long term, at least if they want to get ahead financially in the future. Now, I think it goes without saying that if you start with more money, if you contribute more money, the portfolio is probably going to grow a little bit faster. But again, every so often, I like to make videos going over the bare minimum, more or less, you would need to invest long term in order to build some substantial amount of money. So for this video's example, we're talking $2,500 initial principal, $20 per week beyond that. Invest it into VIG, which offers roughly these numbers. Again, everything is just estimated. Go ahead and mess around with some of these free online dividend calculators though. They're a ton of fun and they can give you an idea of what you're looking like in the future. VIG offers a distribution quarterly. We are going to be reinvesting all the dividends in. Now, before I share with you guys these ending numbers, I'm not saying that $20 per week into something like VIG is going to make you mega billionaire rich, but I am telling you that just 20 bucks per week can actually compound into a nice bit of cash. So the numbers are in. Year number one, your $2,500 investment into VIG would pay you around 32 bucks per year in dividends. Again, not that much. We're talking with small sums of money here. After VIG goes up in price and after those dividends are reinvested in your contribution, year number two, you're just shy of 3,800 bucks. Now, just to cut to the chase, it's going to take some time for the portfolio to compound, but after 25 years or so, the portfolio will now be worth six figures, which again, based off a $20 weekly contribution, I don't really think anyone can complain. Now, 30 years invested, based off these numbers, the portfolio will be worth around $173,000 after 30 years of investing, $20 per week, which obviously most investors will find some extra money to invest more and more and contribute more and more. But again, just to make a video on the absolute bare minimum, you can still build a portfolio with just a few $1,000s into multiple $100,000 over the long term just because of the power of compound interest and if an investor stays invested long enough. Now, one of the coolest things about long-term investing, I personally am right now in my 9th year of investing. As you get to year, I would say 7, 8, 9, 10, 11, that's where you really start to see things curl up. Because again, if you've been compounding your portfolio for long enough, you are going to start to see the power of compound interest take hold and really grow your portfolio at a rate that you have not seen. So now that I share with you guys what a simple investment into VIG, for example, could look like long-term for a long-term portfolio, just to give you guys some motivation and just to remind everyone that it does not take millions of dollars to invest into the stock market to make a substantial amount of money later on. And lastly, most importantly, I want to hear from you guys down below. If you're currently building out a position right now in your portfolio, whether it's a stock or an ETF, what are some positions you're focusing on as we speak? Let me know the ticker symbols in my comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.